welcome to The Explainer. Today, we're taking a close look at Hindustan Petroleum, HPCL. We're going to dig into their latest financials to really understand the story behind the stock's recent performance. So, if you're keeping an eye on the markets, you've probably noticed that HPCL stock got a nice little bump. The big question is, why? Is this just random market noise, or is there something more substantial happening inside the company? Well, as it almost always does, the answer is hiding in the numbers. It's all there in the financial reports. So today, our job is to play detective, follow the clues, and piece together what's really going on at HPCL.
All right, first things first, let's talk about profit, because this is easily the most dramatic part of HPCL's recent story. And honestly, this is where things get really interesting.
Okay, just take a look at this chart. It tells a story of one of the most incredible turnarounds you're likely to see. That first bar, for the year ending March 2023, that's a massive loss. We're talking nearly 9,500 crore rupees in the red. But then, fast forward just 1 year. Look at that giant second bar, a complete reversal to a record profit of over 14,000 crores. Wow. And the third bar? That's this past year, where things have settled into a still very, very solid profit of over 6,800 crores. That right there is a financial roller coaster. But here's the kicker. While profits were going on that wild ride, have a look at the revenue, the total amount of money they brought in from sales. It's almost exactly the same for both years. This is a perfect lesson in why you can't just look at revenue. The real story here wasn't about selling more stuff. It was all about how they managed their costs and margins. Okay, so profits are back. That's great news. But does being profitable automatically mean a company is financially healthy? Not always. To get that answer, we got to look a little deeper at the balance sheet, and specifically at its debt. Before we get to the numbers, let's quickly unpack this term, debt to equity. The easiest way to think about it is to compare it to your own life. It's kind of like looking at the size of your mortgage versus your total net worth. It just tells you how much a company is relying on borrowed money to run things. And yeah, a higher number can definitely mean higher risk. And this timeline, it tells that story of risk and recovery perfectly. See, back in 2022, the ratio was pretty stable, right around 1. But then, boom, March 2023, it shoots up to over 2. That's not a coincidence. That's the same year they had that huge loss. But look what happens next. They got to work, and you can see them wrestle that number back down, getting it to a much more manageable 1.3 by March 2025. It's a textbook case of seeing a risk and bringing it back under control. Now, to really appreciate how powerful that profit rebound was, check this number out. During that peak profit year, 2024, HPCL's return on net worth was over 34%. So what does that actually mean? It means for every 100 rupees of shareholder capital in the company, it generated 34 rupees in profit. That is an incredibly efficient performance. Now, for 2025, that number normalizes to about 13%. And you might look at that and think it's a big drop, but it's not a bad thing at all. It's actually a good sign. It shows a return to a more sustainable, repeatable level of profit after that one extraordinary year. It's still a really healthy return. All right, we've looked at profit, we've looked at debt. But, there's an old saying in finance, profit is an opinion, but cash is a fact. So let's follow the actual money trail to see where the cash came from and, just as importantly, where it went. The best way to think about cash flow is to break it down into 3 simple buckets. First, you have cash from operations. That's the cash the company makes just from its main business. Then you have cash for investments. That's money spent on stuff to grow the company, like new facilities. And third, cash from financing. That's money that comes from borrowing, paying back loans, or paying out dividends. And here is that cash story for 2025, all laid out. You can see their main business was basically a cash machine, bringing in over 14,000 crore rupees. So what did they do with it? Well, they poured over 10,500 crores back into the business to grow, and they used another 4,100 crores for things like paying down debt. This tells you they're investing heavily in the future, which is exactly what you want to see from a company that's planning for the long haul. Okay, so let's zoom back out.
We've gone through the profits, the debt, the cash flow. What's the big picture takeaway when you put all these pieces of the puzzle together? When you boil it all down, it really comes to these 4 key points. 1, an incredible rebound in profitability from that tough year in 2023. 2, they got their debt levels under control, pulling back from that peak risk. 3, their main business is a cash-generating powerhouse. And 4, maybe most importantly for investors, all this financial health is leading directly to shareholder rewards.
And here it is, the tangible proof of that whole story. A final dividend of 10.5 rupees per share. You know, a dividend announcement like this is more than just a payment. It's a powerful signal from the company's leadership. It says, we're confident this recovery is real and it's here to stay. It's a direct reward to the investors who stuck with them through the bumpy times. So there you have it. The numbers don't lie. They tell a clear, compelling story of a dramatic recovery and a return to solid financial ground. HPCL navigated a storm, got its debt under control, and is now back to rewarding its shareholders. Which leaves us with the really exciting question: what does the next chapter hold?